Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today by a repeat guest. We've got Dave Meyer, the head of real estate investing at BiggerPockets. Dave, welcome back to the show.
Thank you, Jamie. It's great to be back. I appreciate it.
Yeah, so I'm so excited that we could dig into the housing market because being in a show sort of focused around short-term rental data and investment, like we are in the housing market. Like you can't be a short-term rental investor without sort of being in deep into what's happening either in single-family homes or multifamily homes. And like you just released or early this year, later in 2024, your real estate investing report for the upcoming year. And man, it's been a wild year again for single family investment, for commercial real estate investment. And I'm really excited to sort of pick your brain on what you're seeing and what you're expecting for the year ahead.
Great. Yeah, it has been a very interesting year and will continue to be in the future, in my opinion. So happy to jump into it.
Yeah, I feel like you could like look back over the past year and like if we would have recorded this in September, if we recorded this in like November, if we would have recorded this in December and now January, it could have been entirely different like sort of vibes on like how we're feeling about the housing market. We might be coming in at like peak like negative vibes on like what to expect, but excited to sort of get your sense because like if we look back at when we were talking last year, like there was this expectation around affordability that interest rates were going to sort of marginally get better and home values were going to see some appreciation, maybe not a huge amount, and that we were going to largely avoid a recession and see sort of moderate income growth. And that was going to sort of help the housing market and that affordability would get a little bit better. So what happened and how are you feeling today?
Well, affordability has been just very volatile. I think since this is a data show, we can just be a
Yeah.
little honest about it. Like, I think affordability, excuse me, is going to trend down over the long run, slowly. Like, we're going to see some progress over the next few years, but it's going to be a very bumpy ride. And we're seeing a lot of bumps right now. I am happy to see that we're no longer at 8% mortgage rates where we were in late 2023, but we've obviously seen things shoot back up since they almost touched 6% in August and September. And housing prices just kept going up. And so affordability has not improved materially, although Redfin did just put out a report that said it didn't get worse last year. So I think we'll take whatever good news that we have right now. And it didn't get worse for the first time in 3 years. And we could talk about forward looking, but that's sort of where we stand today.
Yeah. And how do you sort of explain the disconnect between affordability and home values?
It's confusing. It really is. And I think the short answer is that people are just spending more of their income on homes than they have traditionally. And in the past, it was pretty stable what percentage of your income, your after tax income, you would spend on housing. And over the last few years, we've seen that really accelerate, that people are spending up and perhaps spending less on other parts of their lives and choosing to spend more on housing by buying a home. And so that's one of the big questions for me going forward with our whole economy is it inevitable that we go back to sort of the average of affordability, or are we going to stay in this era where housing takes up more and more of income? And there is precedent for that in a lot of other economies, advanced economies similar to ours, whether you look at England, Canada, New Zealand, Australia, they all spend a higher percentage of their income on housing than we do in the US traditionally. I'm not saying that's a good thing. It's just a big open question that has yet to be resolved.
Yeah. So, and maybe isolating sort of single family long term rental investment right now of you see that as maybe having a detriment on the investment side of I'm going to have to pay more to get that home, but maybe a benefit on the rental side of I'm actually going to be able to maybe charge more rent and generate higher cash flows. But that rental market for single family homes is also sort of, I'm guessing, interacting with the sort of rental market for multifamily, as someone can choose between staying in a multifamily home and or a single family home. So, how have you seen sort of rents play out over the past year? Like, is it sort of keeping up with the appreciation on home values, or
Yeah, rents have been really flat for the last couple of years. You can break it down, and the short answer is that multifamily rents are generally believed to be down a little bit, especially in real terms when you compare it to inflation. They're down. Whereas single family homes are pretty flat, about in line with inflation. And so as investors, that's hard, but we also need to remember that there was just this massive rent growth from 2020 to 2022. So it's what economists would call a pull forward, where a lot of the growth, normally you see consistent 5% rent. We saw, 10, 15% rent for a few years and now 0% rent growth. So that's happening. The other major thing that's going on is there's just this huge glut of multifamily supply that's kind of causing this whole rental problem. And we do have a housing shortage in the United States. Depending on who you ask, it's somewhere between 3 and 7 million homes or units. But what happened during the pandemic was rents were growing so much and it was so good for multifamily developers. They all started building at once. And it takes a couple of years for those projects to be completed. And now we're seeing them all come online at pretty much the exact same time. In the grand scheme of things, within about 18 months, we're seeing all these deliveries of new homes. It's flooding the market with units, and that is causing property owners and operators to compete with each other. And they do that by lowering rents. And so we are in this short-term period where rent growth is stagnating, but we could talk about this again in the future, but the pendulum will swing back because construction on multifamily units is now very low. And I think it's going to take another 6 to 12 months for all these new units to work through the system. But I'm actually pretty bullish on rent growth from starting in 2026 going forward because that pendulum is going to swing back in the other direction.
okay? So it is like, and you think about availabilities and rental availabilities as sort of things come online, like it can really expand the time that sort of everything's sort of sitting and waiting to get rented. And when that happens, like people start to cut rents because and any home that's sitting there empty is not earning revenue. And like you got to sort of clear it through the system. And then once it gets cleared, like you don't have all these things coming available at the same time anymore. You've got people staying for longer, and 2, 3, 4, 5 years, and you're able to see a more normal sort of leasing cycle. Is that right?
Yeah, I think that's sort of what we'll start to see. You have to think about these multifamily developers. They're putting on, 50, 100 units at the same time. And so they need volume quickly and they'll lower prices to get it because, just imagine having 50 vacant units. It's going to cost you a ton of money. And so they'd rather bring people on or offer rent concessions, which is a really common thing, 1 month of free rent, 6 months of free rent, whatever it is. And so a lot of developers are doing that or operators are doing that. And it's going to take some time for that to sort through. But again, because there is a housing shortage, there is going to be sort of this long-term tailwind for rental unit demand. And this is where, if you're an investor, the affordability challenges do work to your benefit in some ways, because I believe that there is going to be more persistent demand for rental properties because it's so expensive to buy a house. Families that would normally choose to purchase a home are going to rent because it's a better economic decision. Now, I know there are non-economic elements of whether people want to rent or buy a home, and those are totally valid. But I think because the economics are so clearly in favor of renting right now, that people will, and that's going to create demand, especially in my opinion, for single family rentals because they're harder to come by.
Yeah. So maybe let's talk about that demand for housing and maybe investor demand for housing. Because if maybe a lot of people are bought into that thesis that yes, it may be a tough time for affordability now, like, and what are the big investors doing? Are they buying? Are they selling? I personally always go back to, I love these stories. Like when I was in the hotel investing sort of arena, uh, the brokers would joke around what part of the cycle we're on. They're like, if things are really good, like you got the big institutional players, and then once things start to get frothy, like you'd have the institutional players pull back, and then the doctors would start investing. And that's when that was the sort of indication that like maybe like this isn't the best time to invest. But when you look at sort of investor demand for single family investments, like where are we at that point? Like, do you still see demand? Do you still see investors buying, or are they selling? Like, what do you see them doing?
There's a couple answers to that. I'll say that the high level is that there has been a pullback in investor activity along with all sorts of investor activity. So just for context, in 2022, there were about 6 million homes sold. This past year in 2024, about 4 million. So we've seen a 50% decline in all transactions. And during the pandemic, we saw a peak of investor share of home purchasing, which was about 20% of all units, about 25% of single family homes. Both have fallen. Total volume for investor transactions has fallen along with everything else. But now investors do make up a smaller share of the total proportionately. So now it's down like 17 or 18%. So it hasn't fallen that dramatically. I think when people talk about what's missing in that, though, is that institutional investors have pulled back. A lot of people talk about Wall Street is buying up all the homes. It's not really true. 1 to 3% of all homes are bought by institutional investors. The bigger player in the investor space is small investors, people like myself who buy, a couple of units. The 90% of rentals in the United States are owned by people who have 10 units or fewer. So it's a lot of small landlords, and those people seem to continue to be buying. It's people who are a little bit more methodical and who focus really on one individual area and who can negotiate hard on individual properties and do really good due diligence on everything they buy. Whereas institutional investors, they need to do this at a scale that honestly doesn't really make sense right now because there aren't that many good deals. There are good deals out there, but you have to work for them. You have to look for them right now. And hedge funds, they're just going to put their money somewhere else right now because it's too much work. The one thing I'll say that they are doing and is an interesting trend is something called build to rent. If you've heard of this, it's basically traditionally, up until the last few years, almost all housing developments were built to sell. Now, a lot of institutional investors are creating entire communities and subdivisions, really nice too, not across the board, but a lot of them are very nice facilities. And then their whole purpose is to rent them out long-term to families or to, young professionals. And that trend has continued. And so that is, I think, one of the more interesting areas where we still do see a lot of institutional activity.
Yeah. So I do want to go back to build to rent, but I want to go maybe to the sort of your comment about institutional investors, because think about this sort of narrative in 2021 and 2022 when institutional investors were in the marketplace. So retail investors like me or yourself, like we're trying to get a deal. And then you've got maybe an all cash institutional buyer coming in and like paying 10% or 20% over what you were willing to pay and sort of scooping up all those deals where they were able to sort of make up for the lack of precision on underwriting by the volume that they're doing. Now they've sort of pulled back on the volume and like the precision that you and I can sort of do in underwriting, I still makes sense for us to be investing. And we don't have to compete with those large institutional players that are trying to deploy a lot of money at scale. Is that right?
Absolutely. Yeah, that's exactly right. That idea of the quote unquote iBuying, where people were sort of just buying in mass and algorithmically buying homes, did exist. It was super localized in the first place. Like in the Southeast and the Sun Belt, basically, it was serious. Like if you lived in Atlanta or Charlotte or Phoenix or Vegas, you probably felt it. If
Oh,
you're in the North,
I saw it in my neighborhood.
oh, I
Here in
bet. Yeah,
Atlanta.
you're in
Yeah, yeah.
Atlanta. Like I think Atlanta was the home of the craziest example. There was one zip code, I don't know if you heard about this, where I think some 70% of homes were bought by institutional investors. So it's crazy because I just said that 1 to 3% are bought by institutional investors, but they're super concentrated on these individual areas. And so if you're in those areas, it probably felt crazy. So now in those markets, I'm sure you're feeling a pretty significant pullback. I don't know if you see this personally, Jamie, but like I would imagine that they're buying at a fraction of it. Because I think iBuying in its most recent incarnation is dead. I think it will come back in some new format with new companies and new technology, new business model. But it didn't work. Like the timing was bad. The technology didn't seem to work. And you see Zillow got out of it. Redfin got out of it. I think Open Door, I did they file for bankruptcy? Don't quote me on that, but like I saw something about them doing really poorly. So I think that opens a door for people who kind of use the old school method of negotiating and really diligent underwriting.
No, I suspect the next cycle, when it does happen, we're going to see the phase of, what is it? Will be agentic AI buying.
What does that mean? I don't even know what that means.
Like the whole like open AI operator where it can go in and run your browser and run your model.
Oh, yeah.
And that it's just we haven't seen the sort of phase of what AI is going to do to sort of investing yet. And really since the large LLMs and like all that have really come in fruition, like you haven't seen an investment in any sort of massive scale on real estate yet. So I suspect
It's
coming,
inevitable.
but yeah,
It's inevitable. I always, no one knows what's happening with AI, right? Like it's exciting, it's terrifying, and no one really knows what's going to happen. I think this most recent foray into iBuying shows that the real estate, at least in terms of acquisitions and valuation, is going to be one of the harder things to do because as we've been talking about, 85% of home buyers, homes are bought and sold by home buyers, primary home buyers. Their decision is not cold, hard financial calculations. It's very emotional. And it is super hard to model, how it feels to have your bedroom on a different floor than your child. Or how safe you feel walking a neighborhood. I'm sure they're going to try, but I think that's going to remain a challenge. Personally, I think where they really failed was not even in the valuations, but in operations. Their costs got out of control, and they did very bad job at remodel forecasting, which I'm not sure they'll get better at that either because it's super hard to do.
Yep. And maybe moving it to short-term rentals a bit, and that's one of the reasons why I love sort of the interaction of sort of single-family home investing and multifamily home investing, with moving from the sort of renter being someone looking for long-term housing, but the renter being someone looking for transient accommodation. And because it is, and yes, short-term rental and travel demand is much more, we call it volatile, but it can be very predictable in terms of what are the areas that people want to travel to, what are the reasons why they're going to stay in that area, and what are they willing to pay more for in terms of amenities or access. And like having the data behind that, and the ability to sort of do the analysis of like, all right, like it's going to be really hard for me to make a change to a single family asset in a way that's going to allow me to charge like $100, $200, $300 more a month, because I essentially have to renovate a large portion of that property. Versus if I want to do that for a short-term rental, I may be able to go in and say like, all right, like I'm going to add a hot tub, I'm going to add a pickleball court, I'm going to add like some mini golf, sort of relatively low capital investment, but could have that same sort of return and for a traveler that they're willing to pay for. And when I hear you talk about incomes and its impact on affordability, putting on my short-term rental investor's hat, I'm sort of translating that to sort of property income and how are we seeing incomes change for short-term rental properties, and which can be entirely different than what and sort of driving sort of incomes for people in that market. So it's a lot of fun to, in my mind, to sort of connect the two, but also like there's a lot of different trends sort of driving and what's going to increase incomes for short-term rentals over the next couple years.
Yeah, I'm curious if you have ideas because I want to do them to my short-term rental. I've been thinking about putting a golf simulator in it. I have a spare garage, and I love
Uh-huh.
golf, so I thought about doing something like that. But I think, yeah, you're totally right about the challenge of increasing rents. Oh, rent growth in long-term rentals is a function of macroeconomics, which you have no control over, and then like layout and functionality. It's hard to add amenities to really drive rent. They just don't traditionally have an ROI. Like adding a hot tub to a long-term rental might lower your rents actually, because people like, I honestly, my wife and I were looking at renting a home recently, and we were thinking about it, and I was like, I'm gonna write in the lease that they should drain that hot tub, and I don't want to maintain it. And so something like that. And it's just hard. A lot of it has to do with layouts. If you really want to drive rents, you need to add bedrooms, you need to add bathrooms, you need to make bedrooms bigger, stuff like that. That's kind of challenging to do unless you buy for that, which is, as an investor, what I recommend is like try and find those places where that's going to be easy, where there's an unfinished basement, or there's an extra closet that you can knock down and expand capacity, or you have zoning where you can add an ADU, those kinds of things where the house is primed for that kind of renovation. But if you just take the average home, it can be difficult to do that.
Yep. And that's where, and you mentioned build to rent. I get excited about where short-term rental investing is going because you do see that sort of same trend emerging around. Historically, we've just gone into a market, we found homes that would generate a decent return and sort of converted them to a short-term rental. When in reality, like a lot of those homes, like closets are way too big. There's just a ton of wasted space. You've got a garage that no one's ever going to use. Like the return gets into like, how can I convert that property to like generate additional income as opposed to like, how can I design this from the beginning that's going to be perfect for a short-term rental where I want every room to have an ensuite bathroom, like where a long-term rental, like you probably never want to do that. Like, and yeah, like your kids can share a bathroom. All need one. But when you're doing a 4-bedroom home with that's going to accommodate a bunch of couples, like yeah, everyone like would actually really prefer having their own bathroom and be willing to pay more for that. And that could
Absolutely.
actually
Yeah. That's
generate
a perfect
better returns.
example.
Yeah,
Yeah.
and
Yeah.
that you wouldn't add a garage. Maybe you would add a movie theater though.
Right.
Something that
Yes. Yeah. If you had that space. Yeah, that's exactly right. Like I'm not a short-term rental expert. I own one, but I think about the changes I've made to mine and the improvements I've made. They're totally different from what I would do in a long-term rental.
Yeah. So maybe thinking about going forward now. So we're looking at 2025. We're at relatively high mortgage rates. We're at home values, at least in most markets around the country, that have been appreciating and are probably expected to appreciate more. And we're probably not going to go into recession. Like the economy's going well. We've got maybe a positive tax environment that's going to continue or even get better. People are feeling pretty good about vibes about the economy are feeling pretty good. So, what type of investment strategies are you giving people today, assuming that, and you're encouraging people to continue to invest?
I think that there are a lot of opportunities right now in real estate, but they take 2 to 5 years. I think that's sort of the big mentality and expectation shift that investors need to have, is that most deals on paper, if you just go on Zillow and look it up, probably not going to be a great deal on its face. What you need to do is buy something that's going to be low risk, a solid asset in a good neighborhood, and create value out of it over the next few years. And so in the long term market, that might be, adding a bathroom, like we said, or in the short term market, it's adding amenities, putting it in the path to progress, and really trying to make a business out of it. And the thing is that this is actually how real estate always has worked. It's just that this period from, even if you go back 2013 to 2022, it was kind of this like Goldilocks era in real estate where you could make money doing almost anything. And it was just this function of all of these perfect conditions that came together, and it's probably not going to happen again. And that's still okay. It's just real estate is now going to be for people who devote a lot of time to it and who are committed to driving as much value from their business and are going to treat it like a small business. And so, like the things that we just talked about are still absolutely true. And so I think it works with short-term rentals. It works with long-term rentals. Flipping is actually a great business right now. We're seeing the spread between unrenovated properties and renovated properties increase. So there's potential for margin growth there. So I think there's a lot of stuff there. The big thing is just adjusting your expectation. If you're going to buy a real estate investment, it's going to take 3 to 5 years for it to really reach its maturity and drive the best possible returns.
Yeah, I loved when reading through your list of like sort of recommendations for 2025. The number one was patience.
Yeah,
Of
exactly.
like, and the best deals might be out there right now, but they might not be at the price that
Mhm.
is going to work to drive that best deal. So it's of looking at a whole bunch of properties, maybe going through and I've been doing this now of just like favoriting them on Redfin or Zillow and sort of keeping an eye on price and getting a sense of the ones that would actually work pretty well for short-term rental. And like if they transact at the price that they're going for, like great, good for
Good for
that
the
buyer.
seller. Yeah.
Yeah. Good for the seller, good for that buyer. Like if they don't, if they start sitting, like those are the ones that I get excited about because now sort of patience might sort of benefit me in terms of and being able to reach out to that buyer and they or seller and that they might be more willing to come off a price. Um, and that's and ultimately like and what's going to make that deal work and sort of drive long-term returns.
Yeah, that makes total sense. Just as an example, I went in person to look at a property the other day. Great property. I loved it. And was walking around with my agent and the seller's agent, and it's a 4 unit. They wanted 950,000. And I was thinking in my head, I was like, there's just no way it's worth it. As we were leaving, the seller's agent said, you know, that 950 is my client's price, not my price. And he said, I think my price starts with an 8. And I was like, well, when it gets down to an 8, give me a call. Cause it's 950 is not reasonable. If it was at 850, then we're starting to talk. And I think this is happening all over the market right now where sellers are anchored to ideas in their head that might not be realistic. And I think increasingly, as long as rates stay near where they are, this is going to be a tough market for sellers. And yeah, prices have gone up a little bit, but you can't just ask for these exorbitant prices. And some assets are going to come down. And just the way the market dynamics have worked is these days, if a property sits on the market for even 3 weeks, it almost seems tainted, which is funny to think about historically, because normally 90 days was what it took. Now, if your property doesn't sell in 3 or 4 weeks, people are like, what's wrong with that? And so you start to see these situations where people have a poor initial pricing and need to start dropping price. And it sort of accelerates because people are like, what's wrong with that property? And owner occupants get disinterested in these properties. And that leaves more opportunity for people who are buying based on ROI. to sort of drive and determine the value for these properties. So I think those are good opportunities.
Yeah, the property short-term rental investment that I ended up doing last year, it had actually been launched in 2023, totally mispriced. It sat for 6 months without a single tour,
Wow. Oh my
which
God.
and then they changed the agent. They renovated the basement and then relaunched it in that next spring for $100,000 less. And like first tour was
There you
me,
go.
like, and put an offer on it. Like, of
That's
like, all
awesome.
right,
Yeah.
this is priced right. Like the additional basement, like who knows how much additional value that adds for someone buying it for a long-term rental, but for me doing short-term and be able to put a whole game room down there, like it was a game changer for the property.
Yeah.
Yeah.
And 100
So
grand less. It's a great deal.
100 grand less. So, and that gets into your sort of second theme there was like hidden value of like, where can you find hidden value in a property that sort of given your vision as the investor on how you're going to maybe position or reposition it, like that you can sort of find value that maybe others aren't thinking about around that property.
Totally. Yeah. I think we've talked a little bit about adding capacity. I think for long term investors, zoning, even for short term rentals, zoning upside is a really good one. As we've talked about, there's this housing shortage, and cities and local governments tend to be getting wise to this idea that zoning is restricting the building of homes and it's creating all this upward pressure on rental markets and housing markets. And they're trying to encourage developers or just regular homeowners to add more units, whether it's scraping a really old house that's, rather than renovating, for example, an old house, build a duplex, build a triplex. And so zoning codes across the whole country, red states, blue states, they are changing everywhere. And so this, I think, is a really big opportunity for investors is if you could buy a deal right now that makes sense, but there's this zoning upside where in the future, if you wanted to redevelop the site or if you wanted to add an ADU either immediately or in a few years, I think that's a great option. I think this is particularly useful to people who live in the right areas who want to buy a single family home and are comfortable putting an ADU that they put in a short-term rental. Like to me, that's kind of like an easy button. I would do this myself if I had the option, buy a primary home and build a garage with an ADU over it, rent it out. That will help offset your mortgage. Like that's a great option. That's a great zoning upside where you can combine your primary residence with the short-term rental. So that's just kind of one example of being able to find this hidden value. The other thing I always recommend people, this takes a little bit of work, just like looking at zoning. It's boring. No one loves looking at zoning maps, but it's just like looking at the path of progress and where, for example, local governments are investing in infrastructure. I think, in Denver, I did this a few times or once, looked at where they're putting light rail or train stations or bus stops or where are new grocery stores going. Like these are places that people are going to want to live. You're going to have lower vacancies. And I think it's the same thing is true with short-term rentals. It offers a convenience and, it's not an amenity in your house, but being able to walk to a grocery store, I imagine people see as an amenity, or being able to, in a big city, be close to a subway or a bus that they can take because maybe they're on vacation. They don't want to be driving around all the time. Like knowing those things ahead of time and being ahead of the group or the group think on those types of investments can be really beneficial.
Yeah. No, and I love that. And the ability as a small time investor and going after a few deals and being able to sort of take that sort of outside the box thinking and apply it where maybe a large institutional investor's got to like look at trailing 12-month performance. And if it's not there, like that's a really big risk for them to like deploy a lot of capital, like with that hope that once that light right rail comes in, that it's really going to change the rents that people are willing to pay. But you as a smaller investor, like can sort of get comfortable with that thesis and make that bet.
Yeah, absolutely. Just the example I was using in Denver before is like they added this whole light rail from downtown to the airport. And, you know, I'm sure analysts for a hedge fund have seen that. But were they going to like local zoning committee meetings to know where the stops were going to be? And do you, as a hedge fund looking at this in a computer, understand like within where that stop's going to be the desirable pockets of neighborhoods? As an investor in your local market, you can figure that out because you live there and you can go there and you can experience it and feel it and talk to people. And it's just an advantage that you have over these big players. And I always think whether you're competing against big players or other investors or whatever, just competing against yourself, just think about what advantage you have and like what you can leverage to find the best possible deals and push the best possible returns because it's going to be a little bit different for everyone.
Well, Dave, I feel like that's a great spot to sort of end it. Is there anything else you'd like to sort of leave the audience with, or where to find the most recent report that you put out?
No, thank you so much for having me, Jamie. If you want to check out the report, you can go to biggerpockets.com/resources, and it's just called The State of Real Estate Investing for 2025. And if you want to know more about the housing market, data kind of stuff, similar to what Jamie always talks about, I have a podcast called On the Market where we talk a lot about single family and residential housing data.
Awesome. Well, Dave, I really appreciate it.
Thanks, Jamie.